Welcome to Fundamentals, and as we enter 2017, I'm going to look at the single most popular fund on the AJ Bell Youinvest platform in 2016, namely Fundsmith Equity. The fund's mandate is to generate long-term value growth for its investors, and fund manager Terry Smith and team seek to do this by investing in a very concentrated portfolio of global stocks. According to its latest fact sheet, the £8.9 billion collective has just 29 equity holdings. Now, the criteria used to form this select list of picks are exacting but have been proven over time, not just by Smith & Co, but by investment legend Warren Buffett, amongst others. The fund looks for stocks which have several key characteristics. First, they operate in industries where there are lofty barriers to entry, as this provides pricing power. Second, their businesses are scalable, so they don't need huge amounts of capital to keep growing. Third, they generate consistently high returns on capital employed. Fourth, they don't have a lot of debt. And fifth, they come with an attractive valuation. Now, the top 5 holdings are currently Microsoft, European travel booking technology play Amadeus IT, and a trio of US healthcare players, namely Stryker, Bard, and IDEX Laboratories. The focus is generally more on capital growth than income, as the yield on the fund is around just 0.85% at the moment. Now, this first chart shows the portfolio split by geography. Since we last looked at the fund in the spring of 2016, Smith has added around 10 percentage points to the US weighting and reduced the UK exposure by broadly the same amount. The next chart shows the fund's mix by industry. Note the continued dominance of consumer staples and healthcare, and the also ongoing absence of miners and oil, despite the huge rally in the resource stocks in the second half of 2016. Now, this suggests the sort of company Smith likes offers a degree of comfort and certainty, and I suspect that's why the fund is consistently popular with patient, long-term investors. Smith's policy of backing what he likes, keeping a concentrated portfolio and then sitting tight, will appeal to many, not least as it helps keep costs low. And on the subject of expenses, the ongoing annual charge figure is 0.97%. Fundsmith Equity also has a great track record, ranking as the second best performer on a 5-year view and the best one over 3 years in the global large cap blend equity category where the fund can be found. Now, 2016 actually wasn't quite so good. Fundsmith Equity still offered very healthy positive returns, more than 25%, and it still featured in the second quartile of its 264 peers, although a 69th placed ranking is lower than some investors will have become accustomed to. Remember though, Smith's style is to patiently pursue a particular type of fund, and what can be loosely termed his quality growth approach, well, that kind of fell out of favour in the second half of 2016 after a long spell in the limelight. Inspired by the Brexit and US presidential votes, as well as less talk of austerity and more talk of fiscal stimulus, stock markets switched from quality and expensive defensives to cyclicals and turnaround plays. Now, whether this trend persists in 2017, well, that remains to be seen, and it may depend on what President Trump can deliver by way of tax cuts and infrastructure spending. But if it does persist, well, this is an environment that may in the short term not entirely suit Smith's approach. His patient style won't change though, as it's worked over time, so anyone looking at Fundsmith Equity will need a similar long-term time horizon, and also must ensure that the fund fits with their own personal investment goals, target returns and appetite for risk before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.